Next section, extension and enhancement of increased standard deduction. So again, if you remember the old days, we used to get exemption based on the number of people, and we used to get standard deduction. So if you had 4 people in your household and each exemption is worth $4,000, you'd get $16,000 plus a standard deduction of about 12 grand if you were married filing joint. And so that totaled up to $28,000. So what they did in TCJA is they got rid of exemptions and they doubled the standard deduction. So for 2025, the standard deduction for a married joint couple is $30,000. And for a single person, it's $15,000. And for a head of household, I think it's $23,500 or $23,250, something like that. So what this is doing is, again, we're making TCJA permanent, and the new version of things is how it's going to be until Congress changes its mind sometime in the future. So that's 7102. Section 7103, termination of deduction for personal exemptions other than temporary senior deduction. So we're on the third part, and already we are into weird stuff. Okay, so this is the usual changing the dates. So now we're making Tax Cuts and Jobs Act permanent, getting rid of those exemptions. And however, new subparagraph, deduction for seniors. In general, in the case of a taxable year beginning before January 1st, 2029, so that's going to cover 25, 26, 27, 28. So those 4 years. There shall be allowed a deduction in an amount equal to $6,000 for each qualified individual with respect to the taxpayer. What is a qualified individual? For purposes of Clause 1 or Clause I, the term qualified individual means the taxpayer if the taxpayer has attained the age 65 before the close of the taxable year, and 2, in the case of a joint return, the taxpayer's spouse if such spouse has attained age 65 before the close of the taxable year. So for 2025 through 2028, if you reach age 65 or greater by 12/31 of that year, you are qualified for this additional $6,000 deduction. And there is a limitation based on modified adjusted gross income. In general, in the case any taxpayer for any taxable year, the $6,000 amount in Clause 1 shall be reduced, but not below zero, by 6% of so much of the taxpayer's modified adjusted gross income as exceeds $75,000, $150,000 in the case of joint return. What is modified adjusted gross income? There are several different places that modified adjusted gross income is used, and they're usually fairly similar. In this case, it's saying the taxpayer adjusts the gross income. So you'll have on your tax return, you'll have taxable amounts on the right-hand column. But sometimes there are non-taxable amounts. Sometimes there's municipal bond interest, or there's foreign earnings, like from just foreign or Puerto Rico earnings, or something that is not necessarily taxable directly to the US federal. So they add all those back. And that is your modified adjusted gross income. And that is the testing amount for the $75,000 or $150,000 threshold. You have to have a social security number, and this has always been a big push with Tax Cuts and Jobs Act, and subsequently, is that all of these credits and all these deductions require social security numbers. So people who have ITINs are not qualified. And then married individuals, yada yada. Omission of correct social security number treated as a mathematical or clerical error. That's for penalty purposes. If you screw that up, they're not going to throw you in jail, which is great. And yeah, so this is the no tax on social security section, which is a gross simplification. Okay, so what do I talk about the right-hand numbers? So here's just a fictitious tax return, and this person is single, was at least age 65, and had $30,000 of Social Security benefits. So you'll notice that nothing in here addresses the taxability of Social Security benefits in the first place. So the way the math works is that Social Security benefits get tested against total income. And again, there's that Magi add back situation. And then a percentage of that Social Security income may or may not be taxable. So in this case, if Mr. Sample here has Social Security benefits of $30,000, that's the only income. None of it is taxable. Because if you go through the worksheet, which I won't bore you too much with, is that it fails the threshold test, and so zero becomes taxable. Now, but what if Sample had a other income? Let's say we've got, I don't know, let's say there's a pension, right? And let's say that pension has a $75,000 distribution, of which the whole thing is taxable. So then we refresh here, and now, because of this other income, 85% of the Social Security benefits became taxable. So on the front end, we have this sliding scale adjustment of how much of Social Security is taxable. And then if the modified adjusted gross income is for a single person over 75,000, then we're going to get a reduced additional deduction of 6,000. So you can see here that we have between 75,000 of pension and 25,500 worth of Social Security benefits. Then our total taxable income, or sorry, our total adjusted gross income is 100,500. Now, for Magi purposes, they're going to add in the other 15%, the other 4,500 bucks. So this is going to turn into 105 for Magi purposes. And then we're going to get our standard deduction. And then there's going to be a new extra deduction here. And every year, the IRS comes out with new forms. And obviously, it's going to be, if history is any guide, it's going to be down to the wire and maybe past the 12/31 real due date that the IRS updates all of their forms and gets them into a final form so that all the software providers can then create the forms that we can then use. So we have to imagine what it's going to look like at this point. So we're going to have adjusted gross income. We're going to have modified adjusted gross income, which is going to be a little bit more in this case. We're going to have standard deduction or itemized if that person's able to itemize. And then we're going to have this senior exemption or senior deduction of up to $6,000 per person. So if there's two people, it could be $12,000 potentially, assuming modified adjusted gross income is less than 150,000. And if you look back here, that where was it? Yeah, shall be reduced, but not below zero, by 6% of so much of the taxpayer's modified adjusted gross income as exceeds $75,000. So what does that mean? That means for every $1,000, the modified adjusted gross income is above 75. That means that 6,000 is going to be reduced by 60 bucks. Okay, so if we do a little math, what does that mean? That means that if we got 6,000 about 0.06, so at 175,000, because it's going to be 100 beyond the $75,000 threshold, that additional deduction is going to disappear. So if you are a married filing joint couple, it's going to be $250,000, at which point that extra deduction goes away. And we have the $75,000 threshold, the $150,000 threshold, and then the phase out. And then after that, it's going to be zero. So when you're doing your 2025 tax planning or tax estimations for your senior folks who are 65 or older as of 12/31/2025, and this is going to be true from 2025 through 2028, then we have to keep in mind whatever this new phase out threshold is. And so that's the new quote unquote no tax on Social Security. You can see that it's not really no tax on Social Security. This is just, it's going to exempt the majority of tax on Social Security for the majority of people who receive Social Security benefits. But it's not a blanket wiping out of the Social Security benefits being taxable. So it's a two-step that helps most people in most circumstances. So if you're a high earner, then you're still going to be paying taxes. That's just how it is. So that is the senior, or how do they phrase it? Termination of deduction for personal exemptions other than temporary senior deduction. And there's a lot of stuff in here. This is this temporary 2025 through 2028 kind of language. We'll go through those as we find them.